Hey everyone, welcome back to our monthly moment. Today we're breaking down the latest from February and taking a quick look at what turned out to be a volatile and surprising February for the markets. So, macro overview. Experts have said that the overall macro backdrop heading into 2026 is supportive, but risks are elevated. Rapid rotations across markets are creating opportunities, especially in the cyclicals, global small caps, emerging markets, and selective tech. Global growth is expected to stay healthy this year, and in the US, growth should pick up for the first half of 2026, which is driven by tax cuts, business investment, and a stabilizing job market. Inflation in the U.S. continues to cool as tariff pressures fade and AI-driven productivity improves. Expectations are for core inflation to drift back towards the low 2% range by year end. When it comes to monetary policy, central banks appear ready to look past short-term supply shocks as long as inflation expectations stay grounded. And with the new Fed chair leaning more dovish, rate policy could become a bit more flexible depending on how the data unfolds. So now let's talk about February, a month that started with optimism and ended with a hard reality check. The S&P 500 closed the month just under 6880, down about 1%. The NASDAQ fell a little bit more than 3%, and the Dow actually managed a small gain, extending its winning streak to 10 straight months. Defensive sectors like utilities and energy led, while tech and financials struggled under persistent inflation concerns, AI disruption fears, and rising geopolitical tensions. There was a historic milestone. On February 6th, the Dow made history, closing above 50,000 for the first time ever after jumping more than 1,200 points. A strong January jobs report and renewed excitement around AI earnings fueled that rally. But the celebration didn't last. Just a few days later, weak retail sales data sent markets slipping again, and sentiment turned cautious. One of the biggest themes of the month was rising concern that AI could displace entire categories of workers and business models. And that fear was accelerated after Block, which is Jack Dorsey's fintech company, announced more than 4,000 layoffs, which is nearly half of its workforce. Tech stocks felt the major pain. A major software ETF finished February down more than 20% year to date, and financial firms lending to software companies also came under some pressure. On the economic front, January payrolls came in stronger than expected with 130,000 new jobs, and inflation initially looked encouraging. CPI cooled to about 2.4% year over year, and the Fed held rates steady while the market increasingly expected cuts later in the year. But on the final day of February, the narrative flipped. The producer price index came in far hotter than expected. That pushes stocks sharply lower and raised new questions about when or if the Fed will feel confident enough to start cutting rates. So that's where things stand. A supportive long-term macro backdrop, but a market still grappling with inflation surprises, shifting rate expectations, and growing anxiety about AI's impact on the economy. If you found this video helpful, make sure to send the link to your friends, family, even your coworkers. I want to thank you again for the trust you place in me. And as always, if you have any questions, please feel free to reach out to me. Thanks, and we'll speak soon.